Hey guys, in this video, we're going to take a look ahead at the earnings coming in this upcoming week. Now, if you like this type of content, before getting into it, if you can please like the video, also consider subscribing to the channel if you haven't yet. It would really help the channel out a lot as we look to continue to grow. Okay, getting into this video, it's interesting because when you look at the earnings schedule for the week ahead, it looks pretty bleak, not a lot going on, but there's actually a lot of really interesting themes and companies reporting earnings this week. So just wanted to go day by day, talk about some earnings on the horizon. And the good thing about weeks like this, when it's a bit less busy, is you get the opportunity to look into a company or two that maybe you otherwise wouldn't have. So let's start on Monday. On Monday, the earnings that are coming up are pretty minimal. The one company that I'm interested at just taking a glance at what their report looks like is Tilray. So last week we talked about Canopy Growth Corp. These companies in the marijuana space still losing tons of money. Stock prices down huge, tons of competition. I think Canopy was at like 3% margins. So I just want to see how Tilray compared. Looking at their stock price, very similar story, down 90% in the past number of years here. If I take them from the peak, it's at 150 bucks. So they're down almost 98%, let's call it, from the very peak. So just complete value destruction in these names. With that being said, this is still a $1.6 billion company. So you can just imagine at the top how much they were valued. If we just look at some of the things they're doing, at least to try to, limit the losses, they're trying to drive scale. So it looks like they are doing a strategic partnership that may turn into an acquisition of another marijuana player so they can synergize on the back end. I think lots more of this type of activity is going to have to happen before these companies start making money, and it's still a long road ahead. So they're just going to continue to pile on more debt, dilute shareholders more and more until that happens, in my opinion. But just looking at the earnings preview, looks like for this year, or for 2023 rather, analysts are expecting them to lose about 50 cents a share. So that is huge. On a $2.60 stock that's worth $1.6 billion, they're going to lose about 20% of their market cap. So that's like $300 to $400 million for a company that's worth 1.6. So that money's going to have to come out of cash. It's going to have to either come out of dilution for shareholders or whatever it may be. It's just such quick value destruction relative to the cash these companies have and their valuation. And I do not see like a 1 year recovery or anything to profitability. So this is a space I'm staying far away from. Like these companies have like bankruptcy written all over them, in my opinion. If you know more about this space and want to educate me further on how these companies actually have a positive outlook, would love to hear from you in the description. But this is an example of a company that hits none of the boxes for me. I will be staying far away, but I would like to take a peek on how much money they lose just so I can keep up to date with the space after they report on Monday. On Tuesday, the one company that I'm interested in looking at is CarMax. So CarMax, I believe they wholesale and retail used cars. Big company, about a $10 billion company, trading at an 18 times multiple. If we look at their earnings or stock rather over the last year, they're down almost 40%. Over the last 5 years, about flat. So they really just had a run up during COVID as everyone was trying to get their hands on a car. Used cars were super hot as the supply chains of these companies didn't enable car delivery, and it looks like it's come all the way back down. The company's essentially flat over the last 5 years. Going into some more information about this company, because this is one that not everyone may be familiar with. Picked out a couple slides here. One thing that they're clearly trying to highlight is that they only operate in three segments right now: financing, wholesaling, retailing. And within the used car industry, there's a ton more that they could be doing or they can grow vertically into to really expand the coverage of the company. So that's more just like a teaser of they're still small and in early innings of this game. The second thing here is that they're truly a nationwide player. This is a very fragmented industry. You probably see mom and pop shops on the corners that are selling used cars and just used car lots, stuff like that. And they're really trying to make this like a national brand. They can drive a lot more synergy, scale, digitization, etc. So they've been doing, excuse me, a pretty good job so far. You can kind of see their coverage here all over the Northeast, Southeast, and the West. Kind of gaps in the middle, but I guess that's really just following the population for the most part. So that's interesting to see that that's really their focus, and they kind of call it out: a scale of physical footprint, inventory, and logistics provides speed and cost advantages. So if they're shipping cars from one state to another, if they can deliver them to multiple dealerships at once, that enables them to be more efficient than a bunch of dealers needing to ship all the cars to one place or not fill the shipment truck over or whatever it may be. Tons of just synergies in that type of behavior. And then the last thing is just showing their growth over time. I'm not sure if acquisitions are layered in here, but that will kind of get filtered out of earnings per share. Can see revenue growing about 10% a year. It's definitely leveled off in 2020. But then earnings per share, to their credit, is also up in the double digits too. Once again, leveled off after 2020. But overall, pretty good, very profitable, turn to profit every year, which is great to see. Now, looking at the earnings forecast is about, you know, 280, and then next year 290. Let's give them the benefit of the doubt and say $3 a share. So if we go to their stock price and give them $3 a share for next year, they're trading at about 21 to 22 times next year's earnings. It looks like 2022 was like a gangbusters year. That's why the PE is a bit lower. But their stabilized earnings are about 21, 22 times. So, they've had a good growth history, but I'm not paying, in my opinion, in my portfolio, not interested in anything over 20 times that's related to like the used car space or just the automobile category in general. So I hope this company keeps growing. I hope the shareholders do well. Interested to see what they report, but this one's probably not for me. With that being said, it's one I'm going to keep an eye on. The next one today is LVMH. This company owns lots of luxury brands, like from the alcohol space, Moet, Hennessy, from the fashion space, Louis Vuitton, but they own a ton more. It's a huge company, $400 billion. As we just look at what LVMH owns, it's a great just chart here that I wanted to share with you all. Oops, bear with me. That just really highlights it very well. So you can kind of see in the beverage space, Hennessy, Moet are their big ones, but they also own Belvedere, lots of other brands within fashion, Dior, Louis Vuitton. They own some shares of the public company Hermes or Hermes. I can't pronounce all of these names. I'm not really into high fashion. But you can kind of just see across the board, they just play in a lot of different spaces in makeup and in watches, Hublot, Tagore, De Beers, stuff like that. So this is really their types of businesses in terms of just high-end product, high-end categories, selling luxury. Going into some of their data here in investor presentations, it's all very premium. So you kind of see Tiffany they're talking about, Bulgari, Tagore, Hublot, going to some of their other categories like perfuming, cosmetics. I can't pronounce half these brands. So for some of you who may like the nicer things in life a bit more, let me know if you guys think this is sorry. Let me know if these are assets that you think will do well in the long term. But in terms of their stock price, they are trading, or they're expected to do earnings per share of about $32 this year, $35 next year. And when we look at their stock price in euros, it's a pretty expensive stock. If they do $32 this year, they're trading in the high 20s, and $35 next year, they're kind of trading at probably more mid-20s, but still really premium valuation for this company. I think they've done really well throughout the last number of years, and also throughout recessions. Oh wow, huge in the last 5 years, up 200%. And also through recessions, as their consumer is not really the middle class necessarily, but but definitely one that has a lot priced into it. It does pay a little dividend. Not one that I'll be interested in buying, but once again, one that I'll be watching this week as they report their earnings. The next stock is Delta Airlines. So, Delta, obviously a big airline out of the US. They're expecting this year to deliver between $5 and $6 of EPS and over $2 billion of free cash flow. So, just looking back at the stock, $2 billion of free cash flow. So, they're trading 10, 11 times free cash flow levels. Um, Not bad, I guess. And $5 to $6 of EPS. If they do five, they're trading at 7 times earnings per share. So, not an expensive stock by any means. I know they're coming out of the pandemic. Obviously, they may have a lot of debt. Their share price is actually down over the last 5 years, which is expected because of all the dilution that happened during COVID, down 12% in the past 1 year. And then let's just look at analyst expectations relatively in line with what the company's saying. So analysts are expecting this company to trade about 10 times free cash flow, 7 times earnings. It's one just from a valuation standpoint that I'm interested in the relative valuation versus other airlines as we get more information and more earnings coming in. I don't personally own an airline. I've never owned an airline, but it would just be interesting to see how cheap these names get in the post-COVID world. Going into the next stock that I'm really looking at. So at the end of the week on Friday, there are a couple stocks I'm looking at. Lots of big US banks are reporting. JP Morgan Chase, probably the most notable, but Citi, Wells Fargo, PNC. And with the banking crisis that's happened over this quarter, it'll be really interesting to hear their thoughts on the crisis, on liquidity, on inflows and outflows. And I think regardless of what the earnings say, the rhetoric and the narrative will really swing probably the stock market, but definitely the banking sector as a whole in one way or another. And I have about 15 to 17% of my overall portfolio in bank stocks. So I'll be looking really closely at that. Second one is United Health Group, huge company in the US. So we'll be looking at those earnings. So let's just start with JP Morgan first. JP Morgan, looking at the stock, $375 billion company, down about 4% in the last year, down 6% year to date, once again, behind that little banking crisis. Over the past 5 years, this one has really traded pretty much sideways, up about 3% annually with a 3% dividend. So you're probably getting about a 6% return. Not terrible, but definitely hasn't taken off. What I find interesting is just looking at the company's expense outlook from last quarter for the year ahead. And you can kind of see labor inflation, annualization of incremental hires from 22, headcount increases, investments in technology, marketing, bankers. It's just interesting because this isn't really the expense management that you'd see from a company that's overly worried about inflows versus outflows or a banking crisis or stuff like that. They're investing incremental dollars in headcount, marketing, advanced technology, stuff like that. So I am expecting it to be business as usual for these banks, and the cheaper multiples that they've traded on over the last month behind what happened with Silicon Valley Bank and stuff like that will eventually evaporate. They'll go back up to the recent multiples, 10% higher than where they were. So that's my estimate. We'll see what happens. I'm not buying this stock specifically, but I have been adding to the banks that I do own in my portfolio behind that thesis. In terms of EPS, looks like they'll earn about $12.75 this year, $13.25 next year. So looking at their earnings, they're really forecasting to earn about 10 times earnings, or trading about 10 times earnings currently, which for a big bank, I'd say is in line with the industry. I just think the overall industry is probably trading a bit cheap. Given the defensibility of some of these names and how they've been around forever, realistically, the government would probably bail them out if needed. I feel like they deserve to be at least 12, 13 times multiples, but I really don't mind. They've traded cheaper than I would have imagined they should for a while, and I'll just keep buying and letting my returns compound over time. Going into the last stock I want to talk about today, it is United Health Corp, or United Health Group rather. So this stock, $480 billion company, down about 5% in the last 1 year. but has performed super well over the past 5 years, really riding that healthcare trend in the US, trading at about 24 times, pays a little dividend. What I needed to figure out was, how does United Health Group make money? It's funny and won't waste time on it, but on their website they just talk about how they're revitalizing healthcare and they're trying to make healthcare better. But like, I didn't understand exactly how. Like, what are you making revenue and profit from? And it seems like from this summary here, which is great, is that United Health Group is primarily an insurance play, has claims from over 147 million customers. Then they also have a branch that does mail order pharmacy, health savings account, et cetera, payment processor for healthcare providers. But it looks like primarily they are an insurer for health products. So interesting company, obviously playing in a space that will probably go in the coming years with populations getting older, people living longer. Big company, almost $500 billion, one of the biggest companies, not only in the US, but in the world. And also just trading, it seems, at a pretty big valuation. So just taking that into consideration, looking at their expected earnings per share of about 25 bucks, that means this company's trading 21 times future earnings. I just think for me, that's a bit rich, given at the end of the day, they're an insurer. There could be lots of disruption in the healthcare space. You have lots of billionaires wanting to make healthcare cheaper. I don't think they're going to be able to trump a company like this, just given its scale and its size. But I don't think it's necessarily a bad company or stock at face value, trading 2021 times for the moat they have and the space they have, the business they have. I frankly probably just need to learn more about this company, and it's not one that I'm overly interested in. But I think it's an important company for the market, for the world. So we'll be interested to see what kind of numbers they put up on Friday. So there you have it. That's kind of the earnings reports that I'm interested in a relatively quiet week. But even though it's not a lot of companies reporting, some of them are very important. Most notably, the banks, in my opinion, that are reporting on Friday. So we'll have to wait the week for that, but that's what I'm mostly looking forward to. If you like this type of content, please give this video a big thumbs up if you're still watching. It really means a lot, really helps a lot with the YouTube algorithm. Also, not many people watch till the end of these videos, so if you are, let me know in the comments. Would love to hear from you. And lastly, please subscribe if you haven't already. It would really mean a lot to me. Thanks, and I will see you guys in the next one.